Consider how profound that claim really is. We would be changing from a system where business agreements and property rights are secured by the threat of violence and change to a system that uses the very properties of numbers and laws of physics to make many bad behaviors impossible in the first place. But is it really all that valuable in practice? And if it is it viable to make the switch from where we currently are? Hey everyone, this video is sampled from my online course which teaches you tokenomics for fundraising. You'll learn about the fundraising process, key tokenomic concepts, and get a complete spreadsheet model that you'll learn how to use by solving real-world fundraising problems. You can find the link to the full course in the description section below. And if you'd like to support this channel and help me to create more free content, please like, share, subscribe, and hit that notification bell. That's all. Now back to the video. We finally get to the last section of this lecture and ask ourselves, what does this all mean for business? As usual, the answer is complex, and it depends on the specific use case that our blockchain ledger has. But we've only really covered one blockchain use case so far. That's the one where we use the ledger in the same way as our traditional accounting ledgers, to record and control transactions for a simple digital token that has some defined quantity according to established accounting rules. Now that may sound narrow, but it is a very substantial and important use case. This includes every blockchain currency, including Bitcoin, Doge, Litecoin, Dash, etc. And as you may be aware, that's no small portion of the blockchain universe. So that's the specific use case we will be limiting ourselves to for this review. And it's why I said that this was only part one of our look into how blockchains create value for business. We'll look at more of them in the future. So let's quickly refocus on what these blockchain currency ledgers allow us to do in a practical sense. They allow us to transfer digital tokens between different wallets. Think of wallets as bank accounts. They allow us to respect accounting rules that preserve determined finite quantities of those tokens. And that's partly done by limiting the ability of wallets to send tokens to the number of tokens that it holds. Finally, sender transactions are only allowed when users provide a secret cryptographic key. That's something that usually sits in the hands of a single individual. So this all compares pretty closely to some kind of cash or asset deposit service and some kind of internet payment system that pulls funds from our deposit accounts. Note that in these cases, instead of cryptographic keys, we use plastic cards with number codes that we take care to avoid being stolen from us. So not that different. So what are the advantages of doing this on a blockchain? Well, first of all, control of assets located in wallets are cryptographically secure, as long as the key is kept secret from others. Full, complete, irreversible settlement of transactions occurs as soon as they are executed. So if you're a business, there's no longer any need to chase anybody up to complete a transfer of funds when you've made a sale. You can only get back the token balances that existed before a transaction by creating a new transaction that sends the tokens back. No intermediaries are required or involved in any of these transactions. There's no need for a Visa or MasterCard to do all the communications and settlement for you. It's just you and the customer making an exchange. Use of a blockchain may still come with a fee, but in principle, these fees could be much lower than what payment providers currently charge, since blockchain operations are much more deeply automated and effective. Finally, none of these benefits requires any auxiliary institutions or factors to be present. No need for culture, market competition, or institutions to be just right. The full and complete settlements that you get on a blockchain eliminate the possibility of certain kinds of fraud and failed payment events. And you don't need to scare anyone with fines or prison sentence to get that. That happens simply because it's physically impossible for anything else to occur on the network. Now, pause for a moment here and consider how profound that claim really is. We would be changing from a system where business agreements and property rights are secured by the threat of violence and change to a system that uses the very properties of numbers and laws of physics to make many bad behaviors impossible in the first place. But is it really all that valuable in practice? And if it is it viable to make the switch from where we currently are? We already laid the groundwork to answer this question earlier. Remember this slide? The points in the yes column tell us the circumstances where blockchain currency ledgers could add value. But if we stop to think about the situations where these factors are present and where they aren't, we end up in a bit of a bind. Let's take institutional quality, for example, here on the bottom row. Countries that are beset by corruption and institutions with weak democratic service, first of all, tend to be poor, and secondly, tend to be ruled by oppressive regimes that will act to restrict and even punish the use of cryptocurrencies. These points create barriers to adoption of blockchain currency ledgers by businesses and by users. So what about wealthier countries with more liberal economies? They may have less aggressive censorship, but these jurisdictions typically have better quality institutions and payment intermediaries that have already substantially solved the problems that blockchain aims to solve. Let's be honest. Most people in these economies go about their day-to-day without worrying whether the bank or government is going to restrict access to their funds, and most companies go about their day-to-day trusting that payment providers like MasterCard and Visa have control systems that stop fraudulent payments and that duly follow up on settlements. All of this together means that blockchain currency ledgers fail to offer a compelling value case to business owners or to the everyday person. Things are made worse by the bad user experiences and the lack of regulatory clarity that have marred blockchains to date. These have killed any interest in the upside that's left. But topic, all of this is one more critical matter that, frankly, trumps all of these considerations. The elephant in the room for this entire discussion is the question of whether these tokens have any reliable value. At the end of the day, that is going to be the most important factor that affects whether businesses or users become convinced or care about the upsides to using a secure, trustless blockchain. Everyday people rely on the stability of currency values to get by and to make plans that span multiple years without needing to keep up a side hustle as a derivatives trader on the side. But the huge value fluctuations of the highest profile nation-independent cryptocurrencies make it impossibly challenging to run a lasting business. Now, this argument doesn't actually kill the value case altogether, nor do we have to appeal to some hopeful future where nation-independent cryptocurrencies become stable at some point. There is actually a kind of blockchain token that already offers stability today. The chart I've just thrown up is for a stablecoin. These are a type of digital token that have been designed to be redeemable for units of fiat currency on a one-to-one basis. The majority are designed to be redeemable for the United States dollar. So one digital token gets you one ordinary dollar. The safest issuers today back this convertibility with a full reserve of USD cash or cash equivalents. If regulators can agree on an acceptable stablecoin reserve and issuance standard that can be held to account by third-party audit, and then also give businesses guidance on how to use stablecoins compliantly, I anticipate we will see quite a rapid shift into broad-based stablecoin use. That shift will be motivated by the benefits of faster, cheaper, and more secure transactions enabled by these new blockchain payment rails. Now, if things go in this direction, it's probably going to get a mixed reaction from the older blockchain community. These solutions represent the readmission and growing presence of centralized influences from the old world onto the blockchain economy. The value of the dollar is swayed by decisions made by the Fed, a central authority. And full reserve methods that back the issuance of the most secure stablecoins are also centrally administrated. Not least, we're also talking about authorities influencing or determining which digital tokens businesses are permitted to transact in. But even with all of that, you could still argue that those centralized influences all involve activities that occur off-chain, and that, therefore, some substantial decentralization is preserved for activities that occur on the chain itself. However, if the approved stable asset is designed to allow banks or authorities to seize and freeze assets on-chain as they're able to do under the current financial system, then this would be failing to meet the decentralized standards of a true public blockchain. Okay, so now it's time to look back and summarize the key points that we've covered in this chapter, looking at the value add that blockchains bring to business. First of all, the largest long-term upside opportunities may exist in areas that are troubled by corruption or poor institutional quality. However, the development of these opportunities is likely to be frustrated by poor economic environments and oppressive censoring authorities. In areas with lower corruption and stronger institutions, there are still upsides available that could flow from increased payment efficiency, with speed, settlement, cost, and security of transactions all being improved. However, the volatility of the highest profile cryptocurrencies nullify all these benefits. Stablecoins could provide an alternative solution in the near term, but we would still need other improvements to be made, including improving poor user experience, removing real and perceived stablecoin risks, and giving people regulatory certainty and clarity. Once those concerns are removed, growth and adoption of regulated fiat-linked stablecoins could be quite rapid. But you should be aware that if authorities engineer a way to control transactions of these assets on-chain, then this digital currency solution is no longer meaningfully decentralized. But at the same time, users may not care or be aware so long as these powers are not abused. Okay, we really are at the end now of quite a meaty lecture there. We've covered what centralized control is, why it matters. We've looked at how we've managed to defend ourselves from exploits of centralized control until now. We've looked at the key elements of blockchain design and how they enabled decentralized control. And then we finally reviewed the value potential that simple currency ledger blockchains can provide for businesses. That final review left us with a complex picture that may have had less revolutionary implications that some of you were hoping to hear. And yet, all the while, I've been telling you that this is the most revolutionary technological innovation since the internet. Don't worry, I wasn't lying, because even with all that we've talked about today, we haven't even begun to reveal the true power of what blockchain ledgers can do. That's what we'll be doing next time, when we learn about the amazing capabilities of smart contracts. I'll see you there.